You made $180,000 last year, and the lender told you you only made 94. And then they turned you down. I want to explain exactly what happened there because it wasn't your fault. It wasn't your business's fault. And there's usually more to the story than one underwriter's math. I'm Chris Galley, and I've been doing this since 1997. And the self employed file is the one that I see mishandled more than any other. Let me show you what actually happened to your numbers and what actually can fix it. So here's the real math. When you're self-employed, the lender doesn't just look at what your business brought in. They look at what's left after all your write-offs, your net income, not your gross income. Every deduction you took, right? You're going to be writing off your equipment, your mileage, your home office, your phone. Every one of those comes off the number the lender sees. Now think about what you did last year. You did exactly what the tax code rewards. You ran your business smart. You kept your tax bill down, and it just works against you in this scenario when you're buying a home. You spend all year minimizing your income on paper. Then you walk into the bank and ask them to be impressed by it. Those two goals fight against each other. And that's what nobody warns you about, especially when you're buying a home. So how are you supposed to qualify when the tax code from the underwriter want opposite things from you? That's the question. And it gets worse, unfortunately, before it gets any better. Most lenders average your last 2 years. So if you had a great year, that year gets diluted by a normal one. Say you netted 160,000 last year and 90 the year before. You don't qualify for 160. You qualify for somewhere around 125,000. And if your income went down year over year, some lenders won't average it at all. They're going to just go off of the lower number alone. So that's not a you problem. That would be a guideline problem. Now, here's the part that almost nobody tells you. Some of those deductions can actually come back to you through depreciation or depletion. Sometimes the home office, right? One-time expenses that won't repeat, a lawsuit, piece of equipment that you don't have to buy again, or a bad year for one client. A good underwriter adds those back to your income because they're paper losses, not cash out of your pocket. Your truck depreciated on paper. You didn't write anybody a check for that. But here's the thing. Not every lender applies these the same way. Some are more aggressive about add backs. Some barely touch them at all. Some loan officers never even learn about them, which means the same tax return can produce a meaningfully different income number at two different lenders. Same returns, same borrower, two lenders, two different answers. That happens more than people believe. I've closed the exact scenario more times than I can count, and the file didn't change. The math did. So, what if your tax returns just don't tell the real story? Not because you did anything wrong, because that's how write-offs work. There's a loan built for exactly that, and it's called a bank statement loan. I think it's one of the best loans for a self-employed borrower. Instead of your tax returns, the lender looks at the deposits going into your account, your actual cash flow, the money that actually hits your business. Depending on the program, that's usually a year or 2 years worth of bank statements. A business account or a personal account. It all depends on how your business is set up and run. We look at both to determine which one and which set is better. Now, the lender doesn't count every dollar as deposits as income. They apply what's called an expense factor. So in plain English, they assume the same percentage of what comes in goes right back out to run the business. So if half of your deposits go to expenses, they count the other half as income. The exact percentage depends on your business type. Well, let me be straight with you about the trade-off. The rate is higher than a standard loan. I'm not going to pretend otherwise, and I'm not going to quote you a number here on YouTube because it also depends on your file and your specific scenario. So down payment and credit requirements run higher than a standard loan too, where exactly depends on the program and the file that we're looking at. So who is this program built for? You, business owners, contractors, gig incomes, anybody whose bank account tells a better story than their tax returns. No sales pitch, just the numbers. For a lot of self-employed borrowers, this is the difference between a no and a yes that actually makes a lot of sense. But let's take a quick detour because this catches commission earners the same way that write-offs catch business owners. So if you earn commissions or bonuses, lenders generally average it over the last 2 years or 24 months. So we have to take a deeper dive into that. So picture this. You had a breakout year, doubled your production. You're thinking, finally now I can buy, right? Then the lender averages your breakout year with a normal year, and your qualifying income lands somewhere in the middle, lower than what you actually make, lower than what you're going to actually make next year based on your profit and loss statement. Change roles in the middle of that window, a new company or a new comp plan, and it can even get harder still. Some lenders see a reset clock, not a raise. So here's the document that changes the conversation. A year-to-date pay stub showing the trend. If your income is climbing and you can show it in black and white, a good underwriter can weigh that. Not everyone will, but the right one can. So that's the pattern in everything that I've told you today. The guidelines have room in them. The question is whether your lender knows where the room is. That is the big question, and that's the important piece. So if any of this sounds like your file, here's what a second opinion actually requires. These 5 things. 1, 2 years of your tax returns, all schedules, not just the first 2 pages, all pages. 2, a year-to-date profit and loss statement. Doesn't need to be fancy. It just needs to be honest. 3, just 3 months of your business bank statement so we can get an idea of what you're depositing over the last 3 months. And if you got a denial letter, bring that too, because that letter names the actual reason why you were turned down. And half the time, the reason on paper isn't the reason you were told on the phone. And that's it. That's the whole stack. And I can take a look at it to see if it makes more sense. Bring me the file someone else gave up on, and that's most of the business that we do here. A no from one lender is one lender's guidelines meeting your file on a particular day. It is not a verdict on you, and it is not a verdict on your business. So if you're self-employed and you get told no, call me. A 15-minute call, no credit pull. I'll walk you through how a different set of guidelines reads on your file. And you can call me at 941-529-1040. I'm Chris Galley, and thanks for watching.